Or perfect.
All right, we're live. It's past 2 Eastern, so we'll give people a few minutes to stream in. No pun intended. Alfred, remind me where you are. You're in Southern California, right?
So our CEO's down in Southern California. I'm out here in the Bay Area, San Mateo. Probably 10 minutes south of the San Francisco airport.
Yeah.
So
yeah. I'm surprised that we haven't, but I don't think we've talked about this. I grew up in Burlingame and went to Stanford, so kind of straddled San Mateo for a big chunk of my youth.
I've just been up and down the two coasts here. So grew up in the Bay Area. And then was down in Irvine, Southern California for college, and then came back up for grad school. So I've been up and down California.
Yeah. Where'd you grow up?
Cupertino, so Apple's backyard.
Mm-hmm.
So
you've got some street cred when talking to all of our
I've been in and around the tech folks for some time, and in Silicon Valley, and so but yes, kind of seen the area.
Where'd you go to high school?
Monte Vista High, and so also right in the heart of Cupertino. So.
Yeah, totally. All right, well, we'll give people another 30 seconds, but I see the numbers ticking up. If you're here, chime in, let us know who you are, where you're from. We'll say hi. Alfred, we usually see, I'd say like half repeat attendees and viewers here and half new folks. I know we expect to see some people from your side that we haven't met before. People should feel free to chime in, and we'll get started in a few seconds here.
Cool.
Are your clients? I mean, the clients that we've worked with are all California based. Are
most of them. But we do, just over the years, and because we're 100% virtual firm, we get clients from all over, mainly tech hubs, I would say. But in the East Coast, you're going to see the New York Cities, the DCs, right, the Virginia. So those are all areas that we have a concentration of clients.
Totally. Okay, well, good. I guess we've given people a few minutes, so we can dig in here. Welcome everyone to what is, I think, the 31st in the Valur series of webinars on advanced tax planning, but the first in what I hope and expect will be a growing series working with Alfred and his team from Diversifi. The subject here is something that is near and dear to both of us, and especially to our joint efforts. As the viewers will know, Valur's entire business is tax planning. And so thinking and talking about capital gain planning for concentrated stock positions is, probably a third of what we do every day. But so far, it's about 2/3, maybe more, of what we've thought about together. And I'll give you a chance in a second to introduce yourself, Alfred. But, all of our joint clients, and candidly, most of the clients that our advisor partners bring in overall, at least begin from the perspective of, hey, I've got a sale event coming up, whether it's a tender offer with some private stock or an IPO, they're just selling some crypto. This is just a very common posture, and especially for the clients that we've worked on together. So we're excited to talk about that. Very briefly, again, everybody knows, I think at this point, or a good chunk of the names I see here. No, I'm Jeff, part of the founding team at Valur, head of X. We put a bunch of different things there over the weeks. Says head of strategy now. I'm a lawyer by background, and I think hard about this stuff from Valur's perspective. And we're excited today to have Alfred from Diversifi. So do you want to?
Absolutely. My name is Alfred. I head the advisory team over here at Diversifi. I'm one of the 4 partners, on a team of 13. We're a full virtual firm. We've got a majority of our team in the Bay Area, SoCal, and then some out in Colorado, Kansas City. But our main focus has been bringing accessible financial planning advice and education without, always a necessary tie to wealth management. Like wealth management isn't a prerequisite to work with us. We really want to focus on helping folks and giving them the options. For example, working with Jeff Valur team, what's out there and what can you do, across your portfolio. But we're an RIA that manages about 400 million in assets, and with a huge focus, and our main niche is tech clients and growing families in tech.
Yeah, that's right. And again, 100% of the clients we've worked on together have been, I think, current employees. I'm trying to think if there are any former, but I think all current employees of large and growing tech companies. Some, exactly, again, at the middle stages, the growth stage, some very large public companies. We'll talk about some of those in the case studies today. But all what they have in common is big and growing wealth from success in the tech sector over the years. And that is what we're talking about today, right? We're focused on concentrated stock positions. In some ways, this is the subject matter here is gonna be really familiar for those who have watched what we've done in this space over the last few months, because capital gain tax planning is capital gain tax planning. You're thinking about, how do I increase my cost basis or reduce my gain, my taxable gain, via advanced strategies. That applies whether you're talking about concentrated private stock, public stock, cryptocurrency, a small business, real estate, really any appreciated asset. With that being said, one, I know, as you said, Alfred, you all have a real focus on folks with concentrated tech stock. And also, that clientele and those situations do sometimes demand a slightly different take on tax planning, in part because there are strategies that are available only to that group, or only to stockholders, right? We're going to talk about direct indexing and tax loss harvesting, and partly because those families tend to have certain repeated characteristics, right? They tend to be young. They tend to have achieved wealth in many cases suddenly, and that requires a certain way of thinking about it.
Exactly.
So what we're doing today is we're going to talk about how you deal with the tax implications of concentrated stock positions. What that's going to mean is we're going to be talking about diversification. Of course, everyone really knows that's the first stop, right? Do you want to diversify out of your concentrated positions? If so, what are the implications, and how do you do that in an efficient manner? What are the tax consequences of selling your concentrated positions? And then more specifically, kind of addressing or understanding those consequences. What can you do, ranging from the simple to the complex, to reduce those taxes without letting the tail wag the dog? I know, Alfred, you're going to talk a lot about when it makes sense to think about diversification, and when it makes sense to kind of roll with your concentrated positions, and how you all think about that. So, and then of course we'll talk about some real clients that our firms have worked on together, a little bit of math and some case studies, and then we'll leave time for some Q&A. But as you all know, we love hearing questions in real time, so don't hesitate to ask. We'll jump in and answer them as we go if they're relevant, and we'll leave some time at the end. Yeah. So with all of that in mind, as I said, the framing here is you have a concentrated stock position. Maybe it's a bunch of NVIDIA stock, maybe it's a bunch of private stock, Stripe or another big company. And you're sitting on a big gain, an appreciated pot of money. And there are a bunch of questions to ask here. But the first one on everyone's mind, Alfred, this is the first thing that we talked about when planning for this thing, is should you even plan to sell, right? Is diversification a good on its own? Is it just a thing you do in service of a broader goal? I know you all have thought a lot about this. You've written a blog post that I think goes pretty deep in laying out your philosophy. So I'd love for you just to talk through how you as a firm think about that major life decision.
Exactly. And so you hear this so much, right? Which is diversify, 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 but it may not speak to everybody. And we kind of established over the past, 5-6 years, like, why does someone diversify, right? Like the traditional sense of diversification comes around, oh, you know what? It's going to balance out your returns. You have some more stable, there's some maybe fear and risk that comes along with it. So within our client base, what we've noticed is, they look at the their gains. And if you're talking to, like, I mean, just take Google for an example. If someone, over the last 15 years diversified out of Google from their restricted stocks that they were capturing, are they actually better off from a pure net worth perspective today than they were 15 years ago? Maybe not. Probably not, because of how much Google has grown, right? From a pure net worth perspective. So then you have to layer in this behavioral finance aspect of it, and to say, why are we diversifying? Are we diversifying because the client itself really doesn't like the ups and downs? Okay, then diversifying really helps. But what if the client is in their 30s, did really well for themselves, whether it's a sudden windfall or this steady, accumulation of stock? What if they don't mind holding on to this more guaranteed lottery ticket, right? Like it's something that they see. And so, what we've talked about to them is, instead of just diversifying for purely diversifying sake, let's talk about the specific goals that we're diversifying for, so that there's no regret to actually selling. So we'll never hear a client say, oh, I wish I didn't sell my X stock, whatever it is, for the down payment that I put on this home. You're never going to hear that, because they loved buying the home. So regardless of what the price did for the stock, even if it goes up a ton, they're like, I'm so happy I did that because it helped me achieve a life goal, right? And so we approach it from that perspective.
Sorry, didn't mean to jump in there, but the way you're describing that thought process, it makes a ton of sense to me as a person in the world who holds some stock. I have a very concentrated position in Valur stock. It's not Google. Hopefully someday it will be, but that resonates. At the same time, we're living in a moment that is in many ways qualitatively and quantitatively different from the moment 5 or even 1 year ago. And so how does, I guess there are two aspects of the current moment that I think maybe would change or would complicate my thinking if I were a client about whether to stay in one of these concentrated positions. The first difference is, I think I'm not a stock picker. I don't know what I'm talking about here. So rein me in. But I think some people believe that the historic run-up in tech stocks has, if not reached its end, at least slowed. And maybe we saw the lion's share of the generational growth in these companies in the last decade, right? Maybe Google is now a combination of competition in search and AI, and it just being now a 30-year-old company. NVIDIA with competition from elsewhere, with tariffs, lots of reasons. Maybe we've reached a saturation point in AI's use of compute. Maybe these companies have reached not a steady state, but a slower growth moment.
Yes.
And then the second is just, in general, things are certainly more volatile today than they were 6 months ago. So how do those two factors, I guess, play into your thinking for clients around whether they should be letting it ride on their Google or their Meta or their NVIDIA?
Yeah. And then I think where that comes into is to say, where's the starting point? And I think when you hear from these Meta or Google clients or any of these tech clients, so much of the advice that they get, whether it's from, providers that their company provides and want, is just purely diversification, no matter what, right? And I think, don't get me wrong, like when I think about where we are today, like diversification helps in many factors, but the resonating part is huge to say, okay, let's make sure we talk about why we're diversifying and talk about the considerations that you just mentioned. And, I think the aura around a lot of these tech companies over the past 3 years have changed a lot since the layoffs, the 2022, drop in prices, and our clients' view of this long-term hold has changed. But at the same time, being able to go through the conversation of diversification from an aspect of make sure you're doing it for specific goals. And if the goal is to say, I want my long-term, net worth to be successful without as much risk and without reliant on one company, then it does go back to that traditional sense of, yes, then it is still the right idea to diversify. Yeah. I just think when diversification is come across as like, that is something you have to do. Yeah. It really can turn off a client, because no one can predict where the market is. And if the client so strongly believes that one company is the right thing, and their belief is there, then you can help them still diversify by picking goals to diversify for.
And when you add on top of that someone who's being dragged toward diversification against their will, that's a strong way of putting it, but who isn't thrilled about the idea of exiting their concentrated position, when you add on what we're going to be talking about today, which is a pretty significant tax consequence, that can really be a bitter pill to swallow. And so what we're going to be, the angle that I want to take on this today is really, one, to accept the premise that you're describing, which is diversification is not the right move for everyone. And certainly 100% diversification, getting all the way out of these positions, doesn't make sense for most people, especially in these companies where they've built their careers and which they still believe in strongly. With that being said, we've worked with a number of diversified clients on diversifying at least a piece of those concentrated positions. We'll talk about a few clients who have sold 20% of their NVIDIA stock, who have sold half of their their private company or their other public company stock. Where we're going to be coming at this from today is the idea that for some people, some diversification makes sense. And I know that's what you're saying. There are consequences to that diversification, specifically with respect to taxes, capital gains tax. Your clients are mostly in California. That's up to a 35-ish% federal and state capital gains tax all in. Eating away significantly at compounding, even if you think these stocks are just going to match the market, still selling and paying those taxes is going to significantly eat into that compound growth. And as you said, the behavioral part, where the fact of the taxes very often stops people from even thinking about selling, just because they don't want to, a bird in the hand that's worth 100% of what they have is worth more to them mentally than the possibility of paying 35% of that chunk to the federal and state governments, even if in the long run they think it's going to grow more. And so the question that we're going to ask is, assuming you want to diversify, can you get kind of the best of both worlds? Can you diversify while also mitigating, minimizing, or even eliminating the tax consequences of the sale of those assets? The way we're going to come at this is, and we were talking a lot about this beforehand, thinking about what's the schematic here. How do we characterize this? What you see here on the slide is a continuum from what we call short-term planning to long-term planning, and a bunch of strategies along that continuum. I think we agree that that is only part of the picture, and that each of these strategies also falls along a continuum, a second dimension around complexity and mind share and the behavioral side of things. How tough is it to get your head around this, to make a decision and to take action? A big part of our partnership is reducing the effort that it takes to put some of these strategies into place, but still everything to the right of that line there is going to be more complex than, hey, just sell my stock or just hold on to it, right? And so we're going to think about where each of these strategies falls on that line, and how your clients think about coming at this stuff.
And it's to demystify, right, what's on this line, because, what's on that left of just selling is something that they understand. And, making that assumption where we've gotten to a point where we have agreed on whether it's how much to sell or should they sell or whatever it might be, the amount that we've decided to, a client might just say, and we'll jump into this, is like, oh, well, you know what, like, I don't really know or understand, or some of these things are right. And it makes them, just like the market, if they're not familiar with investing in the market, it's the fear of the unknown, of the ups and the downs. It's in this case, fear of the, how long do I have to set things away for? Is this permanent? No. Is it really saving me this much tax, right?
And also, did I miss the boat? Am I too late to pursue one of these things? Should I have been thinking about this 10 years ago? And we're going to talk about all of those things here. So let's just jump right into it, and we're going to walk along that continuum. We'll talk about each of these strategies. It's a messy thing. This isn't linear, but we think this kind of adequately captures the stack of things here, and when and how clients tend to think about this stuff. And so the first item, which is really, if you think of this as two dimensions, at the bottom left, it's the easiest or simplest, and the thing that requires, in some ways, the least advanced planning, is just sell, right? You own a concentrated position in NVIDIA. You've made $5 million. You want access to the funds so you can do a combination of reinvestment and deploying capital into the life projects that make you excited, like buying a house, paying for college. And so instead of pursuing anything else that might reduce your liquidity or have other complications, you just sell the assets.
Yeah.
This is a strategy that is the easiest thing to pursue. At the same time, for a lot of reasons, most clients want something more. So before I turn it over to you, Alfred, what I want to say here is we tend to see this kind of throw up your hands, I'm just going to sell attitude. I want to hear when you see this, but we tend to see this most often in what I think of as complex sales scenarios where anything more is just too difficult. And so the example I have on the slide here is we talked to a number of clients, including some of yours, who are currently shareholders of Figma and who were involved in the 2023 proposed Figma Adobe merger, where nobody really knew what was happening. Adobe came in and announced that they were going to be buying Figma for $20 billion. The Department of Justice then came in and said, hey, hold on, we're going to take a look at this from an antitrust perspective. Doing any advanced planning there for a lot of people was just behaviorally too difficult. They didn't know when it was going to happen. There are legal limitations on what you can do when you don't have clarity on antitrust. And so there are a lot of reasons why people just in the end said, look, I'm going to wait. I'm going to sell kind of just as part of the deal. They got a second bite of the apple, by the way, because that deal fell through and now Figma is going to have an IPO, which is great for them. But the complexity really for a lot of people just caused them to say, hey, look, I'm just gonna wait and sell my stock. Is that consistent with your experience? Are there other scenarios where you see this a lot?
We do. I think we see it. It still happens today. Like we think, when we see the just sell assets, I don't see it so much as a bad thing. I see it as something, it's part of a multi-tier strategy. Just like someone shouldn't just go and sell all the 100% of their assets without forward planning, it doesn't mean that all assets need forward planning, right? But when what I want to see, or maybe what I don't like to see is to say, hey, a client just sold some of their assets because they weren't sure, and they came back to me and says, I sold, but actually we could have done something else. That's not the type of situation what I like to see. But it'd be okay to say, you know what, of this portion of the assets, why don't we just decide to just sell these and then worry about this side in this way? That's okay, right? And that's a completely okay thing to do. The scenarios, the ones that you don't really have control over. I think part of it also, what's a very fortunate one would be to say a client has made enough money, like, because here's the thing, financial planning wise, they're thinking about, is this pool of money life-changing for me? Is it hitting certain goals? Is it hitting my retirement? But what if that money, Jeff, that pool of money is so large that they've accomplished their goals 3 times over? Okay. And so they'll just take some portion of it, like, I don't care, Alfred, like, honestly, like, even after taxes, like, we're good.
I'm good. Yeah.
And they just sell it anyway because they are able to say, you know what, I can pick the price I want. I see it right now. I'm just going to execute and secure. I'm like,
that's right.
Right.
And we love that. And I think it's funny. Both of our businesses is in optimizing for clients. At the same time, it's a load off everyone's mind when you feel like you don't have to optimize. And in many ways, they've already optimized, right? They've put in the time, they put in the work, they've gotten to a price. We don't want to force it, right? What we're here to do is to make these processes simpler for the folks who actually want to pursue them. And that's where I think the next few strategies come in. We've got a couple more here that I think of as mainstream strategies that are typically implemented at the financial advisor level or the individual client level, as opposed to with a more complex tax strategy firm like Valur. So do you want to talk through how you think about tax loss harvesting?
Yeah, especially with a year like 2022, and this is when I say tax loss harvesting, this is from like a ETF mutual fund level where you can't quite get very deep into where you harvest. So I just think, a client can easily say, well, yeah, 2022, a lot of the recent purchases that I made are down. I can swap that into something else. We might help them do some selection, or we do it for them. And just to offset some of the gains that they've either already sold or are planning to sell.
Is this something that clients typically come to you asking about, or is this something that's part of your typical flows?
It's a part of a flow to say, okay, we've decided to maybe just sell some portion, but in tandem, we might very quickly look and say, well, in this part of the portfolio, you do have some of these losses, or maybe they have a winner here, but they had a loser a few years ago and they just never did anything with. We said it's time to rebalance that and get that out. And so we do that. I would say it's not that often that clients are coming to us and say, well, why don't we tax loss harvest where I just sell? I think it's a conversation of, as they're just selling potentially or having these gains, we could, very easily, do some quick tax loss harvesting to offset some of that gain.
Yeah, that's right. There's a lot that goes into this, but one reason why tax loss harvesting, I think, one, is very common, and two, has achieved, I think, a little bit of a breakthrough over the last 15 years with the general public, is that it actually isn't like the actual carrying out of tax loss harvesting is mildly complicated, right? There are a bunch of robo-advisors that try to do it automatically. You all do it manually. It's not something that I'm going to try to do on my own, really, even though I'm reasonably sophisticated. At the same time, the concept is simple, right? Yeah. Hey, something's down, let's harvest a loss, and we'll bank it. We'll have it to offset gains. That's great. Really easy. You can do it, like you said, at any moment, right? You've achieved some growth. Well, now the market's had a pullback. Let's just harvest some losses. And it seems like something that doesn't require a ton of thought for people, which is good. The next level of complexity, which is in many ways a version or something that enables more aggressive tax loss harvesting, is direct indexing. The idea here being just that if you, instead of owning an ETF or the whole market and loss harvesting by selling that ETF or mutual fund when the price goes down, well, what if instead you owned some subset or even every individual stock in that index, and in a given year, maybe 60% of them go up and the overall index is up, but there are a few small or even significant losers. You can more granularly target those losers to realize gains. So I guess, again, the question for you is, how do you think about when to guide people to the next level of planning, right? This is something that anyone can pursue, requires a little more advanced thought in that you need to be in the positions that you can then split up and harvest. So who's this for, and how do you think about, raising it?
And I could speak to both like a client and maybe advisors that are joining us. Like direct indexing, again, it's a something that has gotten very popular in the last few years. You've got robo advisors who have direct indexing on their platform. But I think when I think of it from a concentrated stock position standpoint, there are, even as a small RIA like us, we can work with, the bigger investment banks out there who have much more sophisticated ways to plan out a tax loss harvesting strategy with specific positions, where you can say, you know what, I can go to them and say, I want a Russell 1000 or S&P 500 like exposure with a 3-year time horizon that I want to unwind these positions, right? Give me an example of where I can show a client, how much I might want to take today as liquidity and then offset with future, losses every year, then selling as well. So this is where the longer term planning comes about, because sometimes a, unwinding of some percentage you've selected could be a 3-year, a 5-year, or even up to a 10-year period of, if you want to really smooth it out, just using direct indexing. And so my take on direct indexing, is that because it's a version of tax loss harvesting, but at a more specific level, it could also be something simple where you just kind of do right away, or you can engage in more advanced partners who have the ability to be more hands-on in the tax loss harvesting while you've shown the client the plan in the unwind, right? And so that's where the more complexity comes in.
Yeah, that's right. One thing that we haven't done much of so far, we're going to turn to this in a minute, is quantifying the potential gains or benefits of pursuing these strategies. One reason for that, we've talked about this but haven't gone deep on it, is that it's heavily dependent on how aggressive you want to be, right? Tax loss harvesting, well, you can harvest losses, and when there are losses, you can cash them in. How much you want to do that depends on how much the market has gone down. It depends on how aggressive you want to be, whether you're willing to switch into similar positions or wait. You got to wait 30 days before you can buy something similar. The strategies we're going to get to next are maybe a little bit more quantifiable, which is, I think, there's a benefit and a drawback to that. With these direct indexing, tax loss harvesting, it's kind of a thing where the client can decide in general, hey, I want to do this, and you can do it for them, and it's generally directionally positive. The next things we're going to turn to are strategies where clients tend to be more discerning and tend to think a lot harder about, well, what is the potential ROI? Is this worth my time, my effort, the fees involved, the lack of liquidity in some cases? And so I just wanted to draw a line here, I think, between what I think of as the strategies that don't require a ton of that deep thought, and then the ones that do.
Yeah.
And so I'm actually going to skip these slides and jump to exchange funds and then come back to CRUTs, which are a little more complex.
Yeah.
We're now in the part of the continuum where the client needs to be thinking more in advance and also needs to be thinking about whether they want to undertake, again, the complexity, the strategic and operational complexity of the strategy, and also wants to give up or wants to trade off in certain ways. So the first one we want to talk about here is exchange funds. We haven't worked on exchange funds together. We don't do a lot of exchange fund work. It tends not to be a fit for a lot of our clients for a variety of reasons I'll talk about, but I like to mention them because they are a plausible fit, especially for folks with concentrated public stock positions.
Yeah. And I will say also, like along this continuum, what you're also focusing on is the change in the liquidity. It's, you could kind of think of liquidity as a way of it's more complex or not, but because the liquidity changes, then, or the commitment changes, it just, to your point, is a little bit more thought provoking of, okay, well, it's not just a tax loss or direct indexing where I could do it or I could not do it. I could stop it now. I could, right? Like you could flip flop. Whereas these strategies that we're talking about is more of a commitment. I think that's where the thought process comes.
That's right, for sure, And I'm gonna dive into that distinction and that point specifically with respect to charitable remainder trusts, which are something we've done together, and as everybody knows, is a big part of Valur's business. Exchange funds, just very briefly, so that everyone is on the same page and has this in their arsenal. Again, for the advisors who want to bring this up with clients, or for anyone who owns a concentrated position, you may want to at least look into this, even if it ends up not being the choice. The way exchange fund works is really simple. This is a pot of shares of typically blue chip public stock where people trade their own shares into the fund, into the pot, and in exchange, they get a share of the diversified pot of assets. And so maybe an exchange fund holds $10 million of NVIDIA stock and $10 million of Microsoft and $10 million of Apple. And of course, those will change over time. Well, now I come in and I hold $1 million of Meta stock. I could sell that stock, as we've been talking about, and I could just eat the tax loss. I could pursue some other strategy. Or one thing I could do is I could trade that $1 million of shares into the fund. Let's say the fund is worth $50 million overall, and I'm putting $1 million of my Meta stock in. Well, now I own 2% of the diversified portfolio of that fund. And I'm exposed now to some ownership of Microsoft and NVIDIA and Apple, in addition to Meta, which I've traded in. And the benefits here are twofold. Really, it's exactly what we've been talking about. You get that diversification. You now own a share of a diversified fund. But critically here, the way the lawyers have set this up, it's not a realization event. It's not a capital gain realization event when you trade your shares in. And so you're able to switch out of a concentrated position in, let's say, Meta stock and into a diversified portfolio of the big tech companies without that tax drag upon the decision to diversify. Right?
Yeah. And I think traditionally, and even today, I'll quickly say, the hardest part about exchange funds is getting into one and finding someone who is, going to take your, top tech company stocks, because there's only so many portfolios of exchange funds out there. Well, they might not need more NVIDIA or Apple to keep that.
They're trying to weight their portfolios correctly.
Exactly. That's the hardest part is if we find allocation of an exchange fund to NVIDIA, it'll close like this. And that's it. Like it's so difficult to get in. And so you have to work with the client ahead of time. This is the pre-planning so that they understand the implications of it.
That's right. Which is a little bit surprising to me that they're so in demand, given that these trade-offs that we have listed here, including that, these things are typically liquidity limited, right? You're not allowed to pull your money
7 years
out. And then the fees are reasonably high as compared to some of these other strategies, but they are popular. And so, worth looking into. I'm going to now go back here to charitable remainder trusts. This is something, again, that our firms, our companies have worked on together. The idea here, and many of you know this, so we'll speed through a little bit. the idea here is that a charitable remainder trust is a lot like an IRA in that it's a tax-exempt account where you can put your appreciated stock. When you sell that stock, you pay no tax, right? The bottom line, just like an IRA, that's the idea. This is a tax deferral mechanism. You take $1 million of your NVIDIA stock, you put it into a charitable remainder trust, and you sell it, because that's what we're talking about here, and you don't pay any tax at that moment. In that sense, this is a much more powerful strategy than a lot of the kind of simpler approaches that we've talked about. Of course, there are drawbacks too. But the idea is you put the money in, you pay no tax, you get distributions over time, and you leave some money to charity at the end. This is something we do a ton of, and I want to talk about one quickly how they work, but then talk about a client that we've worked on together. So again, the idea is, let's just start previewing one of our joint clients. We had a client in his late 30s, early 40s, California resident, who owned, I think it was about $5 million of NVIDIA stock altogether. He pursued a few different strategies, of course, but and we'll talk about those. But he decided to put $1 million into a CRUT. And so the way that worked for him, and I want to ask you, Alfred, in a second, kind of why that might be the thought process for one of your clients. But the way it works is he takes the $1 million, he puts it into the trust. He gets an upfront tax deduction. He pays no tax when selling. He takes distributions, typically between 5 and 11%. In this case, I think it was 6% per year. And then whatever's left in the trust at the end goes to charity. We'll look at a little kind of case study and some numbers. But in general, this thing tends to return, somewhere between 2 and 10x the after-tax returns of tax-naive planning, of course, with some trade-offs. But with that in mind, I guess, Alfred, in general, I know you've done a little bit of work with CRUTs and your clients and us. How do you think about the decision or the balance between the simplicity of some of these other strategies and the complexity, but maybe outsized potential tax savings and returns of a charitable remainder trust? Is it, hey, let's do all of the above? Is it, for some people, one makes more sense than the other? How do you all as a firm think about it?
We think of when a client has the ability to section off parts of their asset and net worth for different things. When a client is ready to start doing that, meaning the net worth has grown to a level where they felt more secure with their basic financial goals, and now they're thinking, what's next? Oftentimes the CRUT planning is really becoming in the forefront because they're able to free their mind back to the kind of conversation we said, which is the set aside, the liquidity differences between a simple versus a more complex strategy. And they're saying, well, yeah, you know what? I've been potentially wanting to give. I didn't know how to do that, right? I wanted to be able to think through, making sure this is hitting my diversification goals, but now you're telling me I can also hit charity by not giving money to tax away. That sounds fantastic. Yeah. Let's try it. So that is the conversation between where they're ready to just, free up their mind of their net worth to think about something else other than, can I retire? Right. Yeah. I think that's when it really starts to play.
Yeah, that's really interesting. In part, one of the signal challenges for Valur has been communicating the idea that a lot of these strategies are ROI positive on their own, irrespective of the ancillary benefits. And so, a CRUT is positive ROI, even if you're not charitably inclined. With that being said, it's absolutely the case that each of these strategies speaks slightly differently to each subset of client, each individual client. And so someone who's charitably inclined or who has more longer term planning in mind, as opposed to immediate gains, is generally going to be much more open and more interested in a charitable remainder trust than someone who's all about, buying their first home, or who doesn't care about the charitable piece at all. And so that makes a lot of sense to me.
Yeah.
Yeah, go ahead.
Oh, and we can jump into the specifics, but it's, when they're also in that mindset of leaving something behind where it isn't just their lifetime to still have an impact is also a common trait that comes up where a CRUT can be helpful while still maintaining flexibility of those annual distributions.
Yeah, that's right. We've got 5 minutes left in the kind of original allotted time. We can of course go over a few minutes, but just to keep moving along. This case study, it's really just to show directionally what these things can do. This is a client that we worked on together. I realized we went with the GitLab example, not NVIDIA. there are a bunch of different clients here. But this was a 38-year-old client in the Bay Area. She was married. She had $2 million of GitLab shares that she was planning on getting out of anyway, which I think is an important feature here. She had decided with you all, with her advisor from Diversify, that they were looking to move out of the position. And then the question was, how can we do so efficiently? And a CRUT came up as a possibility, and it turned out to be a good fit. She had $2 million of shares, $100,000 cost basis, really, early employee, doing very, very well post IPO. We modeled 8% annual growth, which is a common number. And we assumed for her purposes that she didn't need the money right away.
That's right.
Which is a key feature of CRUTs that I think makes them especially valuable. You can defer those payouts. She chose to model it that way. And what you see here is that she, assuming, kind of making those assumptions, is going to expect to do about 3 times as well with the CRUT as she would have without. Now, of course, I guess maybe Alfred, if you can talk for just a minute about the combination of these strategies. I know this client in particular, we haven't talked about this, so don't mean to put you on the spot, but I know this client in particular was also a long-term believer in talk us through how you think about talking to a client who has already pursued a significant amount of tax planning via other strategies. And then we arrive at the kind of D-Day, at the decision point. And now it's time to think about more complex strategies. Is it more of a, hey, let's deal with what's in front of us now, and then we'll come to the complex stuff later?
And just sorry, it might have been breaking up a little bit, but can you hear me okay?
I can hear you fine, yeah. Should I restate the question?
No, I got it. Yeah. I think it is a combination. It always has to be, right? And so like, when you look at the 2 million of GitLab shares, it was a portion of the net worth that they were saying, you know what, we didn't need it. Why don't we just get out of it, right? Like I want to do something else with it. But that's where it wasn't me. It was one of my advisors on the team brought up this strategy of like, we can do much more. And there's a reason why they didn't need the distributions until year 10, because they had so much other things going on in the strategy, part of which was they sold a little bit to hit some goals.
This particular client, the spouse runs a business and they had plenty of liquidity elsewhere.
Exactly. And so it was being able to kind of like talk through that and realizing that because they can look at these GitLab shares as something that they didn't need right away, but they just didn't want to carry the risk that we talked about. They had made that determination of not carrying the risk. We were able to bring up and say, we can not carry the risk, but also do much more. And it made so much sense because
that's right. And I think one of the important features of our work together and of Valur's approach to this stuff, which I want to talk about also next, is because we have built the systems to do this work quickly, efficiently, inexpensively. It's something where you can come to it late. You can make a snap decision. We talk to clients all the time who are planning to sell some of their stock, and their advisor says, hey, just go talk to Valur literally the day before you're planning to do it and see if you want to pursue a strategy. With these clients, they can be pursuing other things throughout their time with the stock, and then at the last minute decide, hey, you know what? I'm interested in looking at something more complex, and Valur can, of course, help, and Diversify can point them in the right direction at the last minute. That does also take us to the last mini case study I want to talk about, which is a client that we worked on together, us and Diversify, not you and me in particular, who, this is the NVIDIA client that I mentioned, who did pursue a CRUT. This was a part of the strategy that the Diversify advisor had pushed for a while as something that made sense for this client. But that was part of a much broader strategy, and that became clear only toward the very end. This is a client, high earner, family is earning a couple million a year, in his 40s, retiring in the next 10 years, wanted to sell off a chunk of NVIDIA stock, not all of it for the reasons that you've laid out, pursued a CRUT, but then also, after selling the stock, realized, maybe I could have done more, or maybe there's more that we can still do. And the Diversify advisor proactively kind of suggested that he look into some of the other things that Valur can help with after the sale. And so this client in particular ended up deciding to throw a chunk of that remaining 2 million of gains into a solar project to reduce a combination of his W-2 income, his RSUs, and then some of that capital gain. He's also beginning to do some early estate planning by putting some of that remaining NVIDIA stock into grats. We're not going to go into the details of those strategies here. That's not the point of today's presentation. The point really is, one, this is a never-ending conversation, right? Yeah. There's always something more to do. And then also just to plug the idea that we're going to be talking about these other strategies together going forward, and they're part of a holistic plan that we put together as a group.
Exactly. It changes too, right? Like, the client might feel a certain way when NVIDIA is 150 and then feel a completely different way when it's 95.
That's
and
right.
I think that those are going to be things where goes back to this, hey, the landscape today is much different. But I will maybe say one thing too, which is of the strategies that we've talked about so far, the eligibility of these strategies changes if they are a current employee or a former employee, right? And so like tax loss harvesting or direct indexing may be a lot more difficult when you're a current employee because of trying to manage the trade windows, exchange funds. We found that some stock plans as a current employee doesn't really like exchange funds versus some do. And so you have to kind of keep that as a in the back of your head as well, as like, when a client is at a company versus leaves a company, what you can use as this strategy becomes topics you need to bring back up, because you may not have all of those strategies available to you. Kind of goes to that what's next in the W-2 income. It was like, well, it's because that client was continually earning and we had to find ways to offset it.
That's right. I want to make one or two more points. We're over. People can stick around, of course. It looks like the numbers are holding steady, so we're doing well here. If you have any questions, please do chime in the next minute or two. But I'm going to talk for a second about the way that we work together to capitalize on those changes. This is actually the same client who set up a grat for some of his NVIDIA stock. That stock went down, and I'm not going to go deep into the way grats work, but suffice to say for today that when assets lose value, it can make sense to set up another grat. And so in the case of this client, what happened was combination of our communication, Valur's communication, letting everybody know that, hey, stock's gone down. There could be some steps that make sense, with the Diversify advisors' proactive work here to come to Valur and the client and say, hey, we might want to think about re-upping the strategy. And then we work together to set that new grad up in a couple of days. It's something that absolutely requires proactive work from the advisors and from Valur, the client's buy-in. But we're in a world where working together, we're able to do this stuff quickly, efficiently, and to remove a lot of what I think of as the behavioral barriers to taking these actions. And so it's gratifying to see that we actually can do this stuff and make it just easy enough that clients can say, hey, look, you're telling me I should do this. You show me the numbers. It looks good. Let's just, put it in place.
Yeah, maybe an anecdotal thing I'll share is we've worked together now. I think it's like 3 or 4 years when we started talking. And one of the main reasons, Jeff, we started talking to was a client had heard about one of these strategies, brought it up to an estate planning attorney, a very traditional estate planning attorney that maybe wasn't as familiar with equity comp and niche. And their comment was, and I remember it was like, that is such a bad strategy. You should fire whoever suggested it to them. And I think that was the point at which you realize, there are different folks thinking about strategies, maybe with a context that isn't what the context we're using here, Jeff, which is concentrated positions in Y. And by the time we explain this client with you, they're like, it's silly that the other attorney was so, so quickly to shut down the idea without thinking about where the context came from.
Yeah, that's right. And at the same time, I think we're not reinventing the wheel here, and we're not iconoclasts, but we like to be clear about what needs to be done. At the same time, it's really important to get a diversity of voices on this stuff. And that's one reason we love working with you all, is that you think about this stuff very slightly differently than we do. And so we can all bring our unique perspectives, and we get in front of the client and we help them understand that there is a continuum of opportunities here. Maybe for this client, an exchange fund makes more sense than a CRUT. Maybe solar comes in. This is not one size fits all. Definitely isn't. And so, if you're a potential customer or client sitting here today and thinking about this stuff, I think the plug I'd make is just to kind of open your mind and think broadly. Any one or more of these strategies could make sense. And the way we like to think about this is I just saw a question pop up, of course, as we're over time. The question is really just like, is this a quantitative and lifestyle fit for you as the client, or for your clients as an advisor? Very quickly, since we are over, but I'll answer the question since it came in. Appreciate it, Madhakesh. The question is, can you share details on the capital gain reduction when using a CRUT? The 1.02 million to 150,000 here. I want to be very clear. That reduction on this slide was from a combination of using a CRUT and using solar. The typical reduction from using a CRUT in the moment, this difference that we're showing here is the difference in the overall after-tax returns during the client's lifetime. Still huge. They're making $10 million more. The initial reduction is very straightforward. If you put $1 million of NVIDIA stock or GitLab stock into a CRUT, you get two things. The first is you get a tax deduction, typically 10% of the value of the stock on the day you put it into the trust. So if you put in $1 million, you're getting a $100,000 deduction on your personal tax return. For Californians, that can be worth $500,000 of tax savings.
Yep.
And then more importantly, when you sell the stock, you're selling at a 0% capital gains rate in that moment. So instead of paying $350,000 to the federal and California governments on that $1 million sale, you're paying zero. So you get to reinvest the full $1 million and compound that difference. And if you look at the charts over time, put in a little plug for our calculators. If you play with this, what you'll find is that those lines diverge because of that initial difference. You're just reinvesting the full $1 million instead of a lower number. And that difference is compounding over the years. And that's where you get this very large difference over time.
Yeah.
So that's all I have to say about that. Alfred, I guess I'll turn the floor over to you for any parting words here.
Yeah, I think it's, working with Valur and the partnership has shown me a couple things, which is, these tools that are out there, we, before working with Valur, thought they were also very complex, hard to get to, long to set up, costly. And so when you think about our relationship now in the past 4 years, we're very easily able to bring it up in the spectrum of things and then share with clients that it can be done, right? Here's the details. Here's some of the savings that can happen. We are able to do it in a very timely fashion, which makes it feel like it's just another thing that we can engage in without feeling like it's some very terrible big wall that we have to climb to get to. And that's a big thing when you think about financial planning concepts. Is I love simplicity, and simplicity for clients is very helpful for them to understand where their money is, what it's going to do, because that's ultimately what they care about. Yeah, so right. We're able to bring these strategies to them, which is awesome.
That's right. And I think we think about this the same way, right? Valur's entire goal is to simplify this complex stuff. Same for you, and we appreciate the fact that the cases that come to us working with you all are simplified, are simple. You've cut through the noise and put this in front of the client in a productive way. And so, I guess I'll leave you all with these calls to action. You can check us out at valur.com, our knowledge library at learn.valur.com. Of course, check out Diversify at diversificapital.com. If you have any questions on the tax side, shoot me an email, jeff@valur.com. If you'd like to talk with Diversify about them helping you with your financial planning, especially if you're a tech employee, but even if you're not, you've got Alfred's email here, alfred@diversificapital.com. And then I guess two more plugs. One is we've got our ongoing biweekly seminar series. We're talking about QSBS planning next, something we've also done with some Diversify clients. So register for that, come check it out. We will send out a recording of this one. And then also, although it's not on the schedule yet, Alfred, I know we were talking, and we will be coming back together to talk about some of those other categories of planning that we've done together across estate tax, ordinary income, and the like. So keep an eye out for that. Check it out, register, come get the recordings. And appreciate you all taking the time to listen. And Alfred, of course, to sit here and chat with me about this stuff. It's always fun to connect. So appreciate everybody, and we'll talk to you soon.
Thank you so much for having me.
All right. End stream. It's not letting me end the stream, so I'm gonna remove all of us from the From the thing, it may already be over. I can't tell. It's freezing up. So anyway, Alfred, appreciate you doing it. We'll do it again, and it'll be even smoother next time.
So, thank you.
All right, I'll talk to you soon.